Today we explore the world of YieldMax funds and the mind behind them, Jay Pestruccelli. Jay's journey into options trading started unconventionally. He was fascinated by how large firms use complex option strategies to hedge risk, but noticed these strategies were inaccessible to the average investor. This sparked a mission to bridge that gap, a mission that led to the creation of Zyga Financial and YieldMax ETFs. What's fascinating about Zyga is how they've packaged Wall Street know-how into these ETFs, making sophisticated strategies available to everyday investors. The core of the YieldMax approach is generating yield, maximizing income for investors. Their most popular products are the YieldMax ETFs, which utilize covered call strategies on a variety of underlying assets. These range from individual stocks like Tesla and Nvidia to broader indexes like the Nasdaq 100. Initially, YieldMax focused almost exclusively on maximizing income. This meant that there was a potential trade-off in a strong bull market where upside might be limited. However, the YieldMax team is known for its responsiveness to community feedback.
They understood investors wanted yield, but also craved stability and the chance to participate in market upswings. The team adapted, and many other ETFs now utilize call spread strategies. This allows for greater upside potential while still targeting those attractive yields. This responsiveness is a key differentiator for YieldMax. They're not static, they're actively managing, tweaking, and refining based on market happenings and investor needs. A prime example of this adaptability is the YieldMax LTI ETF. This ETF focuses on high volatility stocks like Tesla and Nvidia. Initially, ALTI was all about income generation. However, the team implemented a collar strategy combining a short call spread with a long put spread to limit downside risk while aiming for that target yield. This change provides a cushion during market dips without sacrificing the income objective. This responsiveness to investor needs goes beyond just strategy adjustments. It's also reflected in the way YieldMax structures their products. A good example is the introduction of the YieldMax ETF. This fund of funds holds a collection of YieldMax ETFs offering investors a one-ticket way to diversify their holdings.
This was a direct response to feedback from investors who loved the YieldMax concept but sought a broader approach to risk management. Beyond diversification, there was a clear desire for more frequent income distributions. YieldMax recognized this and introduced weekly payouts for YieldMax. This shift towards weekly payouts is a growing trend in the ETF world. ETFs like Roundhill's QDT and XDT, which also offer weekly payouts, have seen a surge in popularity, further validating this approach. The introduction of weekly payouts and the creation of the YieldMax ETF exemplify how YieldMax operates. They're not just about creating complex products. They're about making those products work for investors in practical, tangible ways. They're bridging the gap between sophisticated Wall Street strategies and the everyday needs of income-seeking investors. Now let's delve into one of the most fascinating aspects of YieldMax's approach, their willingness to embrace unconventional ideas. One example is their perspective on the size of their funds. Jay has often pointed out that the size of YieldMax funds has been a positive factor in their trading operations. He argues that managing larger sums of money can actually be advantageous. When you're trading large blocks of options, you tend to get more attention from market makers. This smoother execution can translate into better pricing and ultimately better returns for investors. It's a glimpse into the world of institutional trading where scale can be an advantage. YieldMax is leveraging this advantage to benefit everyday investors. Another unconventional approach is their openness to short-term trading strategies. Jay has stated they're not afraid to take profits when opportunities arise, even if it means holding a position for just a few days. This active approach contrasts with the more passive buy-and-hold strategies that many associate with ETFs. It showcases their dynamic approach, their willingness to adapt to market conditions and seize opportunities as they arise. This unconventional thinking extends to their views on reverse splits, which are often seen as a negative signal in the stock market. Jay, however, has argued that reverse splits in the context of YieldMax funds are purely technical maneuvers and don't affect the overall value of an investor's holdings. They're sometimes necessary to keep the share price within a desirable range. He even suggests that in some cases, reverse splits can be beneficial to long-term investors because they can attract new investors hesitant to buy funds with very low share prices. By increasing the share price through a reverse split, the fund can appear more attractive and stable, potentially leading to increased trading volume and liquidity. It's a counterintuitive perspective that challenges the traditional view of reverse splits. It's another example of YieldMax's commitment to transparency and their willingness to educate investors, reframing potentially negative events into opportunities for growth. This commitment to investor education is also evident in their openness to exploring new strategies, even if those strategies are complex or unconventional. A recurring question from the YieldMax community is whether they would ever launch a fund employing a wheel strategy. The wheel strategy involves selling covered calls, and then if the stock is assigned, selling cash-secured puts to potentially buy the stock back at a lower price.
It's a strategy that has gained popularity among income-focused investors, but one that Jay has expressed some reservations about, particularly when it comes to implementing it within the framework of an ETF. He's concerned about the potential complexity and the need for active management, which could be challenging to achieve within the structure of an ETF. However, he's acknowledged the community's interest, and it's something they're continuing to evaluate. Another frequently discussed strategy is shorting the VIX, a bet that market volatility will decrease. Shorting the VIX can be a risky endeavor, as volatility can spike unexpectedly. Jay has expressed caution about this idea, highlighting the potential for substantial losses. However, he's shared insights on how they monitor the VIX when making trading decisions for YieldMax funds. He emphasizes that the VIX is just one piece of the puzzle. They're also looking at implied volatility earnings announcements and overall market sentiment. The goal is to find the sweet spot where they can maximize premium while managing risk. Even though they haven't pursued a VIX shorting ETF yet, the fact that they've discussed and considered it highlights their commitment to staying at the forefront of the options-based ETF space, constantly exploring new possibilities. This exploration extends to their views on the relationship between investing in YieldMax funds and investing in real estate. While acknowledging the fundamental differences between these asset classes, Jay draws parallels. He points out that both real estate and YieldMax funds offer the potential for passive income, either through rental payments or covered call premiums. Both, he argues, require a certain level of expertise and due diligence. You wouldn't buy just any property without research, and you shouldn't invest in any YieldMax fund without understanding its strategy and risks. It's a thought-provoking analogy that highlights the importance of informed decision-making and aligning investment choices with individual goals. This emphasis on aligning investments with individual goals is also apparent in their decision to focus on single-stock ETFs.
Jay has mentioned that one of the primary reasons they chose this route for YieldMax was because investors were already familiar with owning individual stocks. They saw an opportunity to provide a way for people to continue investing in companies they believed in while also generating income through covered calls. It's about meeting investors where they are making sophisticated strategies accessible and understandable. This approach resonates with their core philosophy of merging Wall Street sophistication with Main Street accessibility. YieldMax isn't trying to reinvent the wheel. They're taking a familiar concept, individual stock ownership, and enhancing it with the power of covered calls. However, YieldMax doesn't just blindly sell covered calls on any high-flying stock. There's a rigorous selection process involved, focusing on companies with strong fundamentals, solid growth prospects, and a history of volatility that suits covered call strategies. They also consider factors like implied volatility earnings announcements and overall market sentiment when making trading decisions. It's a dynamic process that requires both expertise and a keen understanding of the market. This dynamic approach sets them apart from many passive ETF strategies. They're not just riding the market. They're actively navigating it, seeking to maximize opportunities and minimize risks. This active management style is reflected in their willingness to adjust their strategies based on market conditions and investor feedback. For instance, concerns about potential NAV decline in certain YieldMax funds during strong bull markets led to the implementation of call spreads in many of their funds. This move addressed the concern about covered call strategies potentially limiting upside potential by creating a more balanced risk-reward profile. A particularly interesting example of this responsiveness is the evolution of the YieldMax Ulti-High ETF, which focuses on high volatility stocks. Initially designed for pure income generation, YieldY faced concerns from investors about potential drops in NAV despite its impressive income potential. The YieldMax team listened and responded. They recently filed to implement a collar strategy for YieldY, combining a short call spread with a long put spread. This move directly addresses those concerns, aiming to limit downside risk while still aiming for attractive yields. One of the most anticipated developments is the upcoming launch of YieldMax's Target 12 ETFs. These new funds aim to achieve a 12% annualized return distributed monthly through a combination of covered call strategies and careful stock selection. The first two funds in this lineup, BIGY and SOXXY, will target the large-cap stock universe and the semiconductor industry respectively. They're designed for investors seeking a more consistent and predictable return profile, in contrast to the potentially higher but more volatile returns of some of the other YieldMax funds. Like other funds in the YieldMax lineup, these ETFs will utilize a dynamic trading approach. Jay and his team will actively manage the portfolios, adjusting strike prices and implementing option strategies based on market conditions and their outlook for the underlying stocks. While maximizing income is the primary objective, They recognize the importance of protecting investors from potentially large losses. They employ various risk management techniques, including diversification, careful stock selection, and dynamic option strategy adjustments to mitigate downside risk and maintain a balanced portfolio. This focus on risk management is further enhanced by their sophisticated technology platform. Their trading team uses this platform to analyze market data, identify trading opportunities, and execute trades efficiently. They're constantly monitoring implied volatility earnings announcements and overall market sentiment to make informed trading decisions. It's a combination of human expertise and cutting-edge technology that drives their dynamic trading approach and allows them to navigate the complexities of the options market effectively. While YieldMax has primarily focused on U.S. stocks, they've expressed interest in expanding into other asset classes like international stocks bonds or even commodities. This potential expansion would allow them to diversify their offerings and provide investors with a wider range of income-generating opportunities. It's a sign that YieldMax is not a static entity, but a dynamic and evolving platform committed to staying ahead of the curve and catering to the ever-changing needs of income-focused investors.
So as we conclude our deep dive into YieldMax funds and the mind of Jay Pestrochelli, it's clear we're witnessing a shift in the ETF landscape. YieldMax is providing access to sophisticated option strategies in a transparent and approachable format, continually innovating to meet investor needs.
The combination of yield-focused active management and a dedication to community feedback makes YieldMax a compelling case study in how ETFs can bridge the gap between complex financial strategies and everyday investors seeking income and growth. Their journey demonstrates that financial innovation doesn't have to be intimidating. It can be accessible, understandable, and most importantly, rewarding.